Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, bringing you another subscriber request Tuesday video. Every Tuesday, I try to do videos where I've gotten requests from subscribers on things they'd like me to cover or talk about or companies they'd like to show. And one thing I've gotten several requests on, and I apologize in advance, I didn't keep track of who gave it, but on my last video, I did get a request from Jose G. And he said, I have a question. You mentioned a lot about analysis on businesses that are mature with history, but how do we evaluate new, young, emerging growth businesses that do not have enough earnings or fundamental information available? I would love to hear your thoughts on this, Chuck. Now, that's a really tough question for Mr. Valuation because obviously, I'm all about evaluating stocks based on their fundamentals. But when you're dealing with young, emerging companies, you obviously don't have a lot of fundamentals to go on. So, you have to try to use some judgment. But I think the key point is this. When you're dealing with young, emerging companies, I believe you have to basically recognize that you're speculating to a great extent, because there are also some interesting aspects about investing in new companies and IPOs and emerging companies that I want to share with you. These are anecdotal experiences that I've had over the years. So let's go ahead and go to FastGraphs and let me try to help you look at some what I'll call young emerging companies. I'm going to go over a couple of different sets here. I'm going to go over some relatively new ones, but I'm also going to be going over some companies that have been around for a while. And one, of course, that's very popular is Zoom. Now, the reason I like to start with Zoom is I want you to notice you've got this enormous growth going on here. In 2019, they actually did manage to earn a penny. And by the way, they have a January fiscal year. The stock price didn't really do much in 2019 when the stock first went public. We had a surge from a very high $70, $72 price. It did get up to $95 before it settled down under 70 and ended the year under 70. And then, of course, in 2019, we had this massive rise in value because everybody was Zooming. COVID came out, obviously, everybody was doing Zoom videos. But now the luster as the economy kind of gets past COVID, or at least is thinking about getting past COVID, we're starting to see a little pressure in the stock. But the point I want to get at is this is a, very fast growing stock. It had enormous growth. Now, we don't even calculate it on the fast graph because you can't calculate. Earnings have gone from $1 to 35 cents to 3.34 to estimated 3.65 this year, and then followed by 4.07. But notice the growth rate is slowing down dramatically here. And that, can partially explain where the stock price is going. But there's another way to look at these. And when you're dealing with young emerging companies, I will often go to fundamental underlying numbers, what we like to call fund graphs on the fast graphs. And the first place I'll go and I'll look at revenues. Okay, I'll go to the income statement and look at total revenues. As you can see here, Zoom's revenues have been growing by 117% a year. So this is clearly a growth stock. The key is, when do you buy it? Do you invest in it early or do you wait? Because I can also go to some of my, ratios, and the ratio that I like is price to sales. Now, this stock is trading at 31 times revenues or 31 times sales. So that's still pretty expensive. But anyway, Zoom is obviously very popular, and it really benefited greatly probably from the COVID where everybody was staying home and doing Zoom calls. And then another one is Slack Technologies. Now, we use Slack quite a bit around our shop. It helps us communicate with some of our associates that are in different states and so on. And it really is a good tool. But here, now we're starting to see something about IPOs and initial public offerings and new growth stocks that I want to focus on a little bit. This company comes out with its IPO in June of 2019 at $37 a share. And you're going to see this quite common, at least I've seen it quite common. IPOs come out with a lot of hype and even a lot, like I like to say, hysteria. People get really panicking. So they come out with very high prices. But you'll see as I go through these, it's not uncommon to see these IPOs have this significant drop in value. Here we saw Slack drop, 44.7% in the matter of, 6 months' time before it rallied again to high prices. So one thing that you might want to consider when you're looking at these young emerging growth stocks is don't necessarily chase them on the IPO. Give the companies a chance to settle, but that doesn't always work out to your best interest. But again, you want to look at this from a standpoint of price to sales or revenues. And what we have here is revenue growth, as you can see, has been very, very strong. Real is actually internet and direct marketing company, and this is a classic picture of an IPO. Look how the stock came out in, again, June of 2019, had this huge collapse, rallied strongly and collapsed again. So from the original IPO at $28.90 a share to March of 2020, not even quite a full year, the stock is down 75.7%, annualizing at 84%. Now, since then, it's rallied again, but even if you look at it from a standpoint of its IPO till today, you'd actually been losing money investing in this company. Now, again, if I go into fund graphs and look at the stock from the standpoint of, how's business, how's the revenue growth? Revenue growth here has been 117%, so that's very strong, and that's kind of how you have to look at these companies. But once again, I want to remind you, you're speculating. So I go into valuation and look at price to sales. Once again, I've got a company that's trading at a very high, price to sales. The next one I want to go into is pin interest. Pin interest was very popular, but again, the IPO, the stock comes out on the IPO. It doesn't do very well for the first year or so, and then, of course, recently we've had this huge surge. Once again, if I go to fund graphs and look at pin interest, here we've got pin interest revenue growing at 48% a year, but I do want you to notice it's slowed down dramatically. We had 61% growth in 2018, 94% in 2019, but only 4%. And by the way, I do want to go back to Slack because I actually didn't have the right graph up there. So let me go ahead and correct that. And let's go back and look at Slack from the same perspective because we have the similar issue. We have 55% revenue growth, but once again, we have a slowdown here. So this is the kind of thing that you want to focus on and pay attention to when you're dealing with these young growth stocks. They often tend to grow very quickly and then slow down. Now, Palantir, I want to switch this. I'm going to switch this to operating cash flow because I've got estimate data here. And you can see estimated growth is not all that strong. But here's a case. A stock came out of the IPO, would have made you a great deal of money, and now is beginning to correct. But the point is, you're dealing with, once again, not a whole lot of information and a whole lot of speculation. And that's the real problem with these young emerging companies. Now, I'm going to kind of end this part with, the Uber and Lyft. These really got popular. You can see initially Uber comes out with a lot of hype, opened in May of 2019 at $40 a share. Stock immediately went to $46 a share before it settled over the course of the next year down to $27 a share. And now, of course, it trades at around $57 a share. It's been very popular. There's been all types of issues and controversy that went in here. But once again, if I go into my fund graph, when I look at Uber Technologies from a standpoint of its income, over the years, you can see that the stock has had this huge surge in income where we had growth of 100%, 42%, 55%, but then we've actually had negative earnings growth here from 2019 through 2020. So there's obviously, some issues brewing there. And then the next one I want to go to is Lyft. Now, what happened with Lyft is they came out with a very strong public, offering in March of 2019, competing directly with Uber. But then look what happened coming out of their IPO. The stock dropped 71% from March 2019 to October of 2020. Now it's rallied again, but nevertheless, if you'd have bought the stock on the IPO, you'd be down roughly 10% annualized per year, down a total of 19.5% total over this, a little bit more than almost 2-year time frame here. But the point is, these stocks are very, very difficult to evaluate because there are no fundamentals, and that's the real key. So let's go back into Lyft here and look at fund graphs and look at what's happened with their revenue over this period of time. And again, just like we saw with Uber, where you saw this huge surge in growth, and now all of a sudden growth is beginning to slow down. So that's something you have to be very, very careful when you're dealing with these young emerging companies. What's also interesting, though, is when you're dealing with young emerging companies, eventually the fundamentals will come into play. And so I'm going to show you some companies that are a little more mature than the ones I've covered thus far. So here's StoneCo, which is a data processing and outsourcing services company. We'll go into the website here if you're not familiar with this company very quickly, just to point out that, the company is into some type of data processing. I'm not real familiar with this company myself, but here's what I want you to see. The IPO came out, it dropped, it rallied, it dropped again. If you owned it, over the course of the first year after the IPO came out, you're actually down, 24% total in, a year and a half's time here. Then we've had this huge rally in the stock. But here's what's starting to happen. We're starting to get fundamental data now. And so now I'm able to evaluate this and look at it, and I'm starting to see that there is an awful lot of overvaluation. But on the flip side, the stock is still expected to grow on a trend line quite a bit. So you're paying a high price for that growth, but you do have some growth here to look at. So again, I'm going to go into fund graphs here and look at this company because now we have a little more data here. And let's go ahead and look at income statement and look at their revenues per share. And we see their revenues per share have grown at 53.6%. But again, it started out 100% growth, 130% growth, 16, and now 2.1 in 2020. And again, we still want to see what, the growth is going to look like getting into 2021. But the growth, this is quarterly data here, the growth is obviously beginning to wane. This is NEO, which is a major competitor. I'm using operating cash flow here. This is a major competitor to Tesla. The stock came out, again, the IPO, you could have held it for, the first year or so and lost 67% of your money and maybe panicked and sold it. Then we've had this huge run up just like we have with Tesla. And now, of course, the stock is, beginning to falter. But once again, you're starting to see some forecast data here, and you can start making decisions based on that. But you start to recognize that, the bloom starts to get off the rose and these stocks are starting to trade on fundamentals. Now, here's Gates Corp, industrial machinery. Here's a classic example. The stock comes out with a very, strong IPO price. It dropped 62% over the course of the next couple of years. Now we start to see the effect of fundamentals. Earnings begin to grow, and the stock is really beginning to rally. And now we actually have some fundamentals to go on where we might actually see a stock here that could be a very interesting growth stock for those of you who are interested in growth stocks going forward. Not, massive, 18% growth is the forecast over the next couple of years. And then here's GreenSky, another data processing company, very, high IPO valuation. The stock since its IPO has fallen precipitously over 77%. And what the message I'm trying to get across here, you got to be careful with these IPOs and these young emerging growth companies, because initially they don't trade on fundamentals, but eventually fundamentals begin to come into play. And now here you have GreenSky, which is starting to actually correlate with its fundamental values. And now we start to have something we can analyze. So one of the messages here is you might want to give these companies a little time. Here's Focus Financial Partners, an asset management company that, works with a lot of, boutique asset managers. Came out the IPO, we had $40.74. The stock rallies to $47 very quickly. And then, of course, it falls down to $26. And then over the course of the next year or so, we start to get some earnings growth. The stock actually falls down to 10. Of course, COVID came along and hit, it like everybody else. But now the stock is starting to trade on its fundamentals, and we start to see that we have a really nice growth stock. So eventually you get a chance to start evaluating these stocks based on their fundamentals, but you're speculating. Now, this is one of the really popular ones out there, but, let's take a look at Dropbox. This is a classic example. Came out at $31, very high valuation. If you've owned this stock all these years, you'd actually be down 15%. You were roughly, looking at almost a 3-year holding period. But now all of a sudden, Dropbox becomes interesting, and it's got, some pretty interesting growth going forward. And now may be a time to be looking at this stock if it's going to continue to grow at 17 or 18%. Let's see, the 3 to 5 year growth rate is expected to be very, very strong. So this would be the time that you might be wanting to start to take a position in Dropbox, or any time, over the last year or so. Dealing with these IPOs is very, very tough. Now, this is Cushman and Wakefield, a real estate, company. You can see their IPO came out, their earnings fell. The stock price, followed that. Now the company's earnings with the hot real estate market is starting to grow pretty dramatically. Now I have something to go on and something to evaluate, but I had to give this stock some time, and I would have been prudent to wait until I really saw what the fundamentals were going to look like. So, can you evaluate IPOs? You have scant data. You need to be aware of that. You need to be aware of the fact that you're speculating with these guys, but there are some very good opportunities that you can make a great deal of money in these stocks. But, you want to own these stocks for long periods of time, because even if you look at a much more mature, what I'll call growth stock like Facebook, which actually turned out to be a strong grower. But I do want you to note here, and it's, kind of hard to see from this iteration. I'm going to try to fix that. But the stock comes out at 29 and then fell down to 18, within the first few months after its IPO. So if I pull the scroll bar back here, you can see this, this is another typical example of the IPO. But once it got kind of close to what I'll call a reasonable valuation, that would have been a good time to be buying Facebook, because as you can see, the stock has, risen, dramatically ever since. And it's turned out to be a tremendous long-term investment, with the price ultimately tracking the earnings. So, these IPOs are interesting. And if you'd have bought it on the IPO, obviously at the $29 price, you'd have still made a great deal of money as long as you'd have bought and held. But there is some short-term risk to be associated with that. And so don't be surprised if it actually happens to you. Now, I'm going to close this video out by looking at Amazon, and I'm using operating cash flow because Amazon is all about the cash flow. I've talked about that many times. Even if I go way back here and use this scroll bar and go way back as far as I can, I want you to see that, Amazon came out at $17 a share, and then a year later, the price was down to $5.97. So if you put this into perspective, buying Amazon on the IPO, you'd have watched over the next year or so, you'd have watched your investment drop over 65%. However, the hat trick here was if you'd have held on to Amazon for all of these years, and kept it in the portfolio, the growth was there, the growth of cash flow. Your long-term performance, as we all know, has been absolutely astounding. A $10,000 investment in Amazon in December of 2003 would be worth over $600,000. If I run this out as far as I can, a $10,000 investment bought on the IPO would be worth over $2 million. So the reality of it is, when these stocks are growing very quickly, like Amazon or some of these others, buying them on the IPO might be risky. Okay, that in the short run, but in the long run, they can really pay off. But you got to make sure you're buying the companies or investing in the companies that are going to grow. And there's not a whole lot of Amazons or even Facebooks that come along every single day. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this. Hope I gave you a little insight on how I would evaluate IPOs and young, emerging growth stocks. I'm going to look at revenues and sales initially. I'm going to, know that I'm speculating. I'm going to be very careful. And with those, I tend to also like to build a position over time. I might nibble a little bit, then add a little more if I do get the correction. If the stock runs away from me, I can always, just look for something else, I guess. However, before I leave you, I do want to make one more point. I meant to show you this. I didn't want to end this with Amazon. I did want to end it with Amazon, I should say. But here is Nikola. Nikola, is a trucker that builds these, that was building these incredible trucks that was using a combination of electric and battery with fuel cell electric powertrain options. And Nikola is the Nikola Tesla, so it was named after Nikola Tesla, if you will, or kind of playing on Tesla's fame, if you will. But the point is, this stock came out very hot as a result, but then the stock has cratered since. So again, I want you to be careful with these guys because, in this case, the company doesn't even have any sales. So, there's a lot of hype that goes on to these young emerging companies, and they can hype you up real good. But then in the long run, it's the fundamentals, as I showed you with this video, are what's going to really matter. Thanks for watching. If you like this video, give me a like, give me ring the bell, give me a thumbs up, subscribe to the channel if you haven't already. And as always, I appreciate you guys. Thanks for watching.